Coming up in this show, I'm going to bring you my opening comments on the markets. Kate has got trade planning with options. She's going to bring you analysis in Home Depot. And then Arvi has trade ideas. He'll be looking at XBI, which is negative. And he's going to be sharing the askSlim multiple time frame analysis. You'll learn so much. And I'm going to bring you analysis on the stock market, multiple time frame analysis in SPY, and we're going to look at the worldwide conditions using our unique market condition monitor. And don't miss our level 1 special. This is the final weekend. You can have 1 month of a ton of our great analysis for just $10. You get a good peek, and that's not recurring. You won't be charged again unless you want to.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward to what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market stalled last week as investors nailed down profits in the face of rising interest rates and historically high valuations. Interest rates have backed up about 60 basis points since the Fed's half-point cut. That shows that the market got way too exuberant. And this was in line with our analysis. And it shows that the market is boss, not the Fed. Still, markets are pricing in a 90% probability of cuts coming up November, December, and cuts out into June of 2025. And our bond market analysis shows that the pop in interest rates is about to end, and bonds get a rally going into year-end. That may be less about the Fed, but more about the economic outlook post-election, and money flows changing, as I think they're going to begin to move out of stocks and into the bond market. Earnings season has really started out solidly. About 80% plus have had earnings beats. And next week is a big week for earnings, as 5 out of the 7 Mag 7 stocks report. Tesla already reported with a big beat, shockingly big beat, and that stock moved up on the earnings. That was the biggest update for it in 11 years. So all with Tesla having reported and 5 out of the 7 Mag 7 stocks coming up this coming week, NVIDIA will be the only one to report, and that's way out on November 20th before they report. So next week could tell a big story. These stocks, with the pricing that they have little room for error. Friday, surprisingly, Apple got a rare downgrade. KeyBank went to sell on that stock. And as defiant as investors are, the stock still was up on Friday. They report after the close on Thursday, and what we're hearing and what KeyBank is saying is that the expected AI upgrade cycle is really not developing as had hoped. That stock could come under pressure pre-earnings. The coming week, of course, is pre-election week. And between nervousness about that and a huge earnings week, volatility is likely to be high. And of course, even the following week through the election day. Our analysis has shown that September-November period was a period of risk. That is a window of time that the market is likely to develop a significant correction. So far, stocks have defied that analysis, and doing that in a way that I consider to be extreme. I'm going to show you a chart right now that I think is very, very important, and you're going to get an idea of what I mean that it is extreme. This chart shows you how the rubber band is stretched. Take a look here as we look back all the way into October of 22. And what we're looking at is a moving average convergence divergence, and also looking at the distance between moving averages. This is a weekly chart, so it's a 13-week moving average and an 89-week moving average. And I want you to see that way back over here there was an extreme. That was the distance between that 13-week moving average and the 89-week moving average. And that is what set up this correction over here, where we saw a very large decline in the S&P 500 over a matter of some 5 or 6 weeks. And of course, the MACD, that distance between the 13 and 89, was extremely high. And then once it began to curl over, well, we were in that correction. This is a really rubber band stretch right there that you can see, and that brought the correction that we had there that lasted into October of 22. Look where we are right now. It is at more of an extreme than we had back over here. And the distance between those moving averages is even further. And what you can see here is that it's still widening there on the weekly chart. So until there is a sign that this is ending, the market can still get more stretched, as it has done. Here you could see a correction hit in here, and that, of course, was the yen carry trade getting unwound during that period. But then the market stretched its way up even further. And I contend it is at a level of stretchiness that is going to bring a very significant corrective period in what we have believed was that correction that was coming, that window of opportunity for a correction. And you can see what happens is that when it gets that far stretched, then it's going to come back down to those moving averages. And you can see the 13-week moving average turning down right over there, which it has not done yet. So this is very key. When it does roll over, when this does turn over, then that's going to tell us that we're in that corrective period. We'll probably get other warnings of that from our other indicators ahead of time, but I wanted you to see that slide because the market is incredibly stretched, and the reactions to that can be quite hard on the downside. I'll show you those charts a little later on in the show. And while the market has been extremely solid, that November, December is a likely period that we're going to see a correction based on the extremes that I just showed. And that likely will bring a few scary downside weeks. Still, overall, patterns show. And when I look at the big picture analysis that you'll see towards the end of the year, that this bull market is likely to extend into 2025. But I'm going to tell you, then I think it's over, and what you're going to see for many, many years is low to negative returns in the stock market. Stocks for the week, we'll call them mixed. Index is down small mostly, except for the NASDAQ, which is up small. The bond market, 30s lose a 1.5, and I think they're buyable, and we're soon going to see a reversal to the upside in there. Remember, when we get into these periods where we're in a bottoming process in the bond market, that we really encourage you to make a small entry, the very smallest unit that you do until the market does confirm. I think we're going to see a sizable upside move in the bond market through the end of the year. 10-year yields up about 12 basis points. They get up to 4.21 right now as we do this at midday. And I don't think you're going to see rates get much higher than that now. Gold market, gold rallies about $13. It gets, right now it's about $27.50. And it's likely to get into a corrective process. Also, I have been thinking that the gold market and the stock market would correct together, and I still think that's going to happen. Gold did make it to $27.72. Our revised upside targets around $2,800 to $2,880 still might get hit, but I kind of think that for now this market is topping, and when it corrects, I think you're going to see gold, silver, the metals all pull back and give us a nice buying opportunity. Dollar gains about 0.5% again, and that's benefiting from these higher interest rates in the U.S. and the safety bid coming in. And I think there's about 1 or 2 more weeks to that And where do I get that from? Well, check our analysis on all of these futures and indexes in the Future Speak show that Arvi does such a great job on Wednesdays. And what he's showing and what I believe is that the euro currency, which is inverse to the dollar, will bottom in the next 1 to 2 weeks. And that is a time when the dollar is likely to peak. Oil gains about $2 and a rebound to about 71, but beware. I really think that the highest probabilities based on our work is that oil will decline through year end and we'll see it move down into the low 60s. So that's a look at my opening commentary on the stock market. Make sure that you get acquainted with us. Go to askSlim.com. Go to the free stuff up at the top and sign up for a free Snapshot Lite. And then you will get information on the stock market every single day, or take advantage of the great level 1 special that I'm going to show you in just a few minutes. YouTube, subscribe to that channel. Click the notification bell, and then you'll know when we put up our videos. And do like this video. Give it a thumbs up. On X, follow me at askSlim. And any questions that you have about the great content that we have about our memberships and anything else that you want to know about what we do, write to Matt at askSlim.com. This is Trade Planning with Options. Katie is just an absolute expert in our cycle analysis and in option trading. She's going to bring you bearish multiple time frame analysis in Home Depot. And you're going to see the confirmation of the negative conditions using our proprietary indicators. She'll show you that. And she's also going to show you how to open up an account at Tasty Trade, which is our preferred options broker. And you can open it up through our website. She'll give you that information. Please do that. That's really the best option trading platform out there. So please open an account through our site.
Hi, this is Katie with askSlim. This is Trade Planning with Options on October 24th, 2024. We're going to look at an options trade idea in Home Depot. First, we have our legal disclaimer. The options trades that I demo and follow up on are trade ideas. When I talk about closing, adjusting, or managing them, I'm educating around management techniques, best practices, theories around mismanagement and profit taking, and highlighting aspects of options trading that we encounter as we follow the trade ideas. This disclaimer is specifically related to options trading. For full legal information, please go to the askSlim website or email Matt at askSlim.com. Let's take a look at the weekly chart of Home Depot. We have an average cycle length of 34 bars, and we are in the late peaking phase, early declining phase of that daily cycle, having tagged the bottom of this target zone here. This week's candle so far is a bearish engulfing, but we still have tomorrow before the candle closes. Momentum is also still positive. So if we were only looking at this chart, we would still be bullish, no cause for concern. The weekly cycle timing window runs from 12:23 to 1:31. Now let's go and look at the daily chart, and this is why we do multiple time frame analysis, because here you can see the weakness that is coming in. We have an average daily cycle length of 39 bars. We formed our prior cycle low here and moved up to a higher high. Then we got a shift in momentum. Our reversal scout turned purple. We then broke the cycle low support, and now the slim ribbon has deteriorated from positive to neutral. So at this point, we would expect rallies to fail, and I've created this resistance zone here using this high and this recent low. So if Home Depot gets back up into that zone, it would set up a good shorting opportunity. Now, you'll notice here we do have earnings coming up on November 12th. So we are going to do an options trade idea that has an expiration cycle before that. We are going to go over to the Tasty Trade platform. They are our preferred options trading platform. If you're interested in them, you can go to the askSlim homepage, go to Partners, and click on Tasty Trade. That will take you to a page right there where you can learn more about them. And if you choose to open an account with them through our link here, that will get you a special bonus, and it does help us. So please do check that out. Okay, here is Home Depot loaded into Tasty Trade. This purple ribbon here shows where earnings are, November 12th. So let's use the expiration cycle right before that. Let's open up that November 8th expiration cycle with 15 days to go. We're doing a short premium trade idea for two reasons. First, the IV rank is somewhat elevated, not extremely high, but not low either. The second reason is because we need to give ourselves some room because Home Depot could move up into that resistance zone. If it had already moved up into the resistance zone and we were getting a momentum continuation to the downside signal, then I would be more inclined to do a long premium trade idea. That hasn't happened yet, but if it does, you could layer on a long premium trade. For now, however, I'm just going to set up a simple short call spread. A short call spread is a defined risk bearish strategy that involves the sale of an out-of-the-money call and then the purchase of a further out-of-the-money call. So let's sell that 415 call. Why that one? Because it aligns closely with the 78.6% fib of the resistance zone on the daily chart. So if the analysis is correct, then Home Depot shouldn't be able to hold above that level. So if you are comfortable with undefined risk naked calls, you could just stop here. It uses quite a bit of capital. But I am going to do a $5 wide spread and buy the 420 call. No particular reason for $5. You could do it wider if you want. I wouldn't go narrower because I like to collect at least $1 in credit, and that would not be the case if I went narrower. Also, the closer your strikes are to each other, then the more friction in the trade, and that makes it hard to take profits quickly. So here's our setup. We collect, let's just lock it in at $1.12 in credit. That is our max profit. Our max loss is the difference between the width of the spread and the credit collected. In this case, that's $388, which is also the capital requirement to place the trade. Our probability of profit is 75%. We have just over 8 short deltas and a daily theta of $4.43. If we go up here, we can take a look at the risk graph. No risk whatsoever to the downside, and our break even on the upside is at 416.12. I will update the options trade idea tracker with this trade idea, and we'll do a follow-up video on it again next week. Now, as always, you can reach me on Discord or via email to katie@askSlim.com if you have questions or feedback.
This is Trade Ideas. Ari is going to share bearish multiple time frame analysis and XBI. Plus, you'll see our market condition monitor. We're going to show you a lot of that during this show. And you're going to see how our algorithms are warning of bearish conditions in XBI.
This is an askSlim trade idea video walkthrough for a short-term short idea in the S&P Biotech ETF for the XBI. It is October 24th, 2024. Okay, so the first thing prior to looking at the charts is I want to highlight what the current conditions are as per our proprietary indicators. And for that, we will use the askSlim Market Conditions Monitor. This is the askSlim MCM, which is available for level 3 and 4 members at askSlim.com. What we see here is we have over 140 symbols here on this list, and level 4 and 4 plus members can actually be notified when there are changes in conditions. And you can see we have our indicators here, and we have the trade setup condition. This can be customized to your time frame. You can see it if I hit this drop down here. We have intermediate term, short term, near term, and intraday. For us, near term is 1 to 5 days, short term is 1 to 3 weeks. Intermediate term is 3 to 8 weeks. So let's go ahead and jump over to short term because we are looking at a short term short idea in the XBI. I can type in the search button. I can hit XBI. And what you'll see here is I'm actually being notified when there are changes in the trade setup condition. And currently that trade setup condition as per our indicators is bearish. So now let's go ahead and hop over to the charts. Okay, so this is the both weekly and daily cycle analysis for the S&P Biotech ETF. On the intermediate term, we are in a peaking phase in the biotech ETF. we have a trough that is due 12.2 to right around 2.3. On the downside, we have a zone from 95.26 to 89.65. For this green track to be activated and to be the primary track, we would need to move through this old high at 103.50. Currently, the highest odds is this black track that we have added in here. If we jump over to the daily chart, and this is where you will see the actual trade idea. We just formed this low here, and we actually did have a nice long idea for members here off of that low. We were able to capture that move here on that little dip, so that was really very nice. After that, we have turned down, and we have seen a test of the 78.6. That is a short-term warning, so we are watching for tests, just as we did here earlier in this afternoon's session, to see a test of that 98.30 to 130 area, and to see this roll back down and look back at this old swing low here and the base, this fib target zones, that's 95.08 to 93.91. If this were to move over the 78.6 at 101.71, that would invalidate the idea, and we have a short-term trough that is due 11.8 to 11.20. Overall, very much in line with the broad market. So that is our look there at the S&P Biotech ETF, along with the underlying conditions as per our indicators. If you have any questions about this trade idea, please go ahead and post it in the comments section below. If you are interested in joining us, please head over to askSlim.com and click on memberships, and you can learn more about all that we have to offer. Thanks again, and have a great day.
Stock market analysis and projections on the S&P 500. First, look at this important information. Please take a moment to read this slide. It tells you about our approach to analysis in the markets and about you using our information and the very, very important aspect of trade ownership. You must own your own trades. This is our level 1 special, final weekend. We don't do this very often. It's really an opportunity for people to really learn about our analysis who have not seen it, or are free members and want to step up and get analysis from us every single day on the S&P 500, NASDAQ, Russell, by getting our stock index report. And that's just a fantastic report. It gives you our 2-hour daily and weekly charts, projections, key levels, and momentum conditions. Matt does a spectacular job with that every single day. You're also going to get our momentum tracker for investors and position traders. It's over 1,000 symbols with our custom algorithms in there, and our directional bias tracker. You're going to see it's fantastic. You'll get our Spider ETF weekly review. You'll be able to use our trade organizer. You'll be able to have access to our Discord channel, which means you'll connect with our communities and get support from our analytical team. And you will attend our Market Week live events and be able to come in there and ask in the Q&A segment about things that you're interested in the market. All of that just $10 non-recurring. Sign up. You will not get charged again if you do that. Take a look how you do that. You just come up here. You see where it says final weekend on our website, and you just click on that, and it gives you all of the information that you're going to want to know and the opportunity to sign up for just $10 non-recurring. Remember, non-recurring. And it gives you an idea of all of the great things that are in this special for level 1. And you'll be getting all of our charts, as you see right over here, our workbench trade planning worksheets, as you see right here, and just so many ways that you can learn. Here's our momentum tracker, which is just spectacular for longer term holders and position traders. You get all of this great information there. All of that included. Just crazy. And oh yes, there's me, early 1980s, doing paper charts, cycle analysis charts on paper. And that was, yes, that was some 40 years ago. Wow. So please do subscribe to our level 1 deal. Click the buy now, and then you will be able to get all of this great information. So please go to the top of our website right now and sign up. Just $10. All right, stock market analysis. We're going to look at cycle analysis and projections and look at our level 4 indicators as we look at the SPY. And we're going to take a broad look at the worldwide markets as we use our MCM. So I'm going to go back to our website right over here. And I want you to see our market condition monitor. So I'm looking at things a little differently in here. You see I've typed in Excel. I'm just going to remove that and type in Excel. And what I have it set up on is the trader style. So you can look at traders or time frame style. And you can look at intermediate, short-term, near-term, intraday. This is for the different style of traders. I want to focus on short-term because we're looking out 1 to 3 weeks in here. And I want you to see the information that's going on. So I'm looking at XL, which is XLB, XLC, XLE. And I want you to see what's going on in the last week. And that is, while the stock market's moved up to test the all-time highs that it's made, and it's still been strong, what's going on in here has been a lot of changes in here that are basically downticks. So XLB ticked down to slightly bearish. XLC was slightly bearish, just to tick up to neutral again today. And you've had a downtick here to slightly bearish in XLE, XLI. XLK has a downtick from bullish to neutral, as you can see right over there. And XLP, you can see slightly bearish right there. And one right over here that we want to see is XLRE, that is bullish, and XLU is neutral, the utility. So this gives you a good idea what's going on in this last several days, as we've had a lot of these algorithms pointing to changes on the downside while the stock market was showing strength. And I think this is important because this could be the sign of the deterioration, the first deterioration, as we get into this period where we think there's going to be a correction. I wanted to look also at world markets. So I can look at that by looking at EW. Just hit EW and it brings up all of these in a row right there of the different countries. And I want you to see here, Australia bearish, EWC gets Canada slightly bearish. We have Germany as neutral, and that gave us a little uptick here today. It was bearish as the market ticked up. EWJ, that's Japan, bearish. EWQ, very bearish. EWU, the UK, is bearish. EWW, Mexico, is bearish. EWY is that Australia is bearish. EWZ is actually had an uptick here to neutral. So I want you to see, not only are we looking at the U.S. sectors giving us warnings this week on the short term, but our algorithms are also warning us about these country ETFs also having these downticks in here, giving us some sense that there is a topping going on under the hood of the market, essentially, is what I wanted to show you. I think this is really important. So let's just look at what's going on here in the stock market. And we have, as we look at the short term, still things are quite mixed as we get these upticks in the Mag 7 stocks. And they are helping the technology, as you can see right there. And let me just get this to show me properly. There we go. And so we have here the SPY as neutral, the QQQ is bullish, and now you see IWM and Dow turning down yesterday to slightly bearish. So we have this disparity going on in the market right now. And for those of you that get our MCM, the Market Condition Monitor, do watch this, especially for the short-term readings or near-term readings. That will then give you a good sense for the market. A lot of what I showed earlier on, when you look at the different groups where I go back to Excel, and I'm just going to do that right now that you can see, while a lot of them are deteriorating on the short term, if I go to intermediate term, these are all bullish to very bullish. XLE is neutral right there. But a lot of them are very bullish. Now, what does that say to me? When the intermediate is very bullish and the short term is deteriorating, that we're very likely to be entering very soon into a corrective period where the market gives ground on the downside, but then moves back to the upside. Like I said earlier in the show, if you watch that, I believe that while the market is entering into this corrective period of risk, that it would likely still continue the bull market into 2025 after what I think will be a scary decline. So that's looking at the MCM, the Market Condition Monitor. This is a level 3 and 4 application, and if you are interested in that, you need to become a level 3, 4, or 4 member to be able to access the Market Condition Monitor. Let's go back now and look at the charts as we do our stock market analysis, and we're going to look at the SPY as we look at weekly, daily momentum conditions and 2-hour conditions. And what's notable in here is that the 2-hour conditions have begun to deteriorate, which is always the first of the dominoes when we go into a correction. Also, if you're watching a clip right now, and or only watching and you scroll to the stock market analysis, go to the beginning of the show. I show another chart in there which shows how far stretched the stock market is on the upside and why there's likely to be a correction that is meaningful. Let's take a look here as we look at the SPY, and we have in all of our important fib extensions, supports right in here, minor supports right there, dominant supports right there. What is minor? Minor cycles, which give us those minor supports, and the dominant cycle right over here. When you have both of them entering into this corrective period is when you have your period of risk. There are 2 downside projections in here, one into early November, one into early December, and I will show you why we have those projections. These 2 vertical lines here are what we call the cycle timing lines, and in here is where we expect the periods of risk, the greatest downside declines, and then to get into a bottoming process when that happens. But when you get into periods where all the cycles are pointing down is where you get into these yellow corrective periods. And, looking back here for many years, they have been extremely consistent, and we're just getting into that period right now. We had originally thought it would be anywhere Q3, Q4, thought it would be September through November. That was the original. Now, because it's been so defiant and held up so strongly, our analysis has suggested that it can now be a little bit longer and get out into that December period. Let's take a look at the short-term patterns that we see in here. Now, I want you to see on the bottom is our option bias study, and that is still green. That is still saying to us that your option positions need to have alongside bias until the market tells you differently. Now, what would be the signals of the market telling us something differently? It would be in this corrective period right over here, getting the first warning under 569.70. That's the 78.6%. If it breaks under 567.80 right over here, that's that cycle low right there, that would be a breakdown that says the intermediate correction has started. So in other words, looking back at the weekly, that yellow zone, if it then breaks underneath right over here, that would be almost a certainty that the market correction was going on. Now, this is that period where the low comes out into early November. So the question is, which of these cycles will make the trough? If the market does not accelerate very strongly on the downside over here, it will warn that this next cycle out over here will bring this decline out into early December. These are those 2 time periods that I'm looking at. We need to get some deterioration before we get that. We see here the slim ribbon is positive right there. We see the reversal scout is positive. Those are all saying the market is still good. However, you can see that this last rally up here, which includes today right there, did not make a new high in the stock market. And I'll show you the 2-hour information is starting to show deterioration, just like I just showed you in the different stock groups or in the different worldwide stock markets. There's a deterioration going on under the hood that very well could mean that the stock market correction is at hand. So this is the daily, still strong, positive. All of that still strong, and the market has resisted the downside still, despite the fact that this shows a period of correction is at hand. When I look at the daily momentum, you can see on here it is still green. This is the an area chart of the slim ribbon, and on the bottom is that extremely valuable slim ribbon PO, which when you get the upside arrows, it tells you that momentum is likely to resume on the upside. And you can see you got that right here. It was perfect. Over here, they were fantastic. And you got another one right over here, which said a few days ago that this market was likely to still try the upside, which it has done. So all of this, again, are still positive indicators that we're looking at, despite the fact that this period of risk is very due and the rubber band is very stretched. The market has not shown the weakness yet, though right now we're getting a little bit of deterioration in here as we look at the intraday on this 2-hour chart. As you can see right here, that the slim ribbon PO has turned red. It is about to give a downside arrow, which we have not seen, well, for many weeks. So that's a reason to believe that something is changing. This is likely to come in the next, maybe today here on Friday or on Monday, where we get that downside arrow right there. You can also see that while the slim ribbon on the 2-hour chart was set up positively here, this stays green and gives you those signals. And this is another reason to say that if you're a short-term trader, you want your positions to be on the long side. Now here again, something is changing and you're getting those warnings, just as we're getting on the short term, looking at the worldwide markets and the individual stock sectors. So a bit of weakening that we see going on right over here. The strong likelihood that this period of risk is going to develop into something significant. Don't really know if it's going to be related to how the market trades around the election time. If you remember back in 2016, when President Trump got elected, the stock market overnight was down about 800 points on the Dow and then reversed to the upside. So we can have a lot of volatility, not only in the coming week before the election, but also around and after the election. I would expect there's going to be some very large moves. And just based on this timing, I have to say I'm looking for the downside. And, of course, I've been looking for this to develop on the downside for weeks, and it has not yet happened. So the market is the boss, not me. So that's the analysis that I bring you, looking at SPY and sharing with you our important MCM, which really gives you such great information. Still, market solid, but a little bit of deterioration going on, and I gave you those key levels on the downside. That will mean that we're either being warned or the stock market is entering into the corrective period. That's it for my update on the stock market. Please do take advantage of our level 1. This special is in its final weekend. Just 1 month for $10 non-recurring. Great chance for you to try us out. So do sign up for that. Always want to remind you, go to askSlim.com and do subscribe to our YouTube channel. Click the notification bell and like this video. Give it a thumbs up. Follow me on X at askSlim. And any questions you have, write to Matt at askSlim.com. That's it. I want you to be so incredibly careful out. So crazy out there. And I'm always wishing you great trading.
Well, I'm going to say